So this is problem 6 and 7 of like-kind exchange and involuntary conversion. We're going to consider these two problems together. So let's start with problem 6. So Coconut trades unimproved land with a basis of $40,000 and marketable securities with a basis of $10,000 for an apartment complex with a fair market value of $150,000. The land and marketable securities were held by Coconut as investments, and the apartment complex will also qualify as an investment. The marketable securities have a fair market value of $25,000. What is Coconut's realized gain or loss, recognized gain or loss, and basis in the apartment complex? So remember, whenever you read a question, first thing you start with is, hey, what's the question asking? It's asking about Coconut here. So we specifically focus on Coconut. And it's also asking us for the realized gain or loss, the recognized gain or loss, and the basis in the apartment complex. Okay. So at this point, after going through the previous problems, which if you have not yet looked at the previous problems in this problem set for like-kind exchanges, involuntary conversions, please look at the previous problems, 1 through 5. At this point, you understand, hey, we got Coconut, right? That's our party at issue. And Coconut has some land, which the land and marketable securities were held as investments. And so Coconut has the land and securities, and Coconut is trading those two things for an apartment complex. Well, the land for the apartment complex, right? So the land for the apartment complex, that trade is considered a like-kind exchange under Section 1031. And the reason why is because you've got real property for real property, and you also have used for business or investment. Now, we also have marketable securities that are being given up as well. So we have the securities, and we know those are not considered like-kind property. Now, we have yet to see a problem where a party at issue, a taxpayer at issue, gives up like-kind property and non-like-kind property for like-kind property. Okay, we have yet to see that. Now, we saw in problem 1 an example with like-kind property with a liability on it, okay, or I'm sorry, taking on liabilities in the like-kind property received, but that's different. This is giving up non-like-kind property. So we have to analyze this the respective consequences. So let's go ahead and start with the realized gain or loss. Now, the first thing I want to talk about as I write out our realized gain or loss calculation, which remember, the realized gain or loss, and by the way, we're starting with number 6 here. We'll go back to number 7. And the way I do number 7 here is you're going to see, I'm just going to erase some numbers because only a few things are going to change to illustrate how things can make a big difference. So remember, the realized gain or loss, the formula is the amount realized minus the adjusted basis. The adjusted basis. And that gives us realized gain or loss, okay? And also remember that amount realized is going to be actual cash received plus constructive cash, which is also known as liability relief received, plus the fair market value of non-cash property received minus selling expenses. But remember, in this problem set for the like-kind exchanges and involuntary conversions, I'm not going to give you selling expenses. But if you had that in practice, you of course would have to subtract that away. That's our amount realized. Our adjusted basis is the adjusted basis of property given up. So here that's going to be the land, of course, and the securities. All right. You might recall in our previous problems, when we did a lot of the different calculations, like determining the basis in the new like-kind property received, remember we subtract away in determining the basis the recognized loss? And I told you that it's very, very, very rare to have a like-kind exchange with a recognized loss. Okay, so this problem, 6 and 7, you will see an instance where we might be able to have recognized loss. And the reason why is because whenever you have a situation where you have like-kind property and non-like-kind property given up, right? So the land is considered like-kind because you have land, right? Real property for apartment complex, real property, and they're both held for investment. And then non-like-kind is, of course, the securities. Whenever you're giving up like-kind property and non-like-kind property and receiving like-kind property, you have to break up. You have to break up the analysis, okay? The way the tax law applies this is it basically says, okay, well, the asset you're receiving, the asset that Coconut is receiving is the apartment complex. Let me rewrite that. Kind of sloppy. The apartment complex. Well, that apartment complex, under the tax law, is going to be broken up into two separate transactions. Now, obviously, it's not happening like this in real life, but the apartment complex is basically going to be broken up into two transactions. A portion of the apartment complex is going to be given for the land, and a portion of the apartment complex is going to be given up for the securities. Now, you're saying in your head, well, Coconut's just receiving one apartment complex, right? Not portions of an apartment complex. Well, the tax law, it breaks up the transaction, right? A portion of the apartment complex is attributable to the land, and a portion attributable to securities. Well, because we're breaking that up, this portion over here is going to be considered a like-kind exchange and qualify for Section 1031, right? Because you've got real property for real property used, held for investment. And then this portion over here is considered, on the right side, is considered not like kind, and no non-recognition rules are going to apply. So we're just going to have to recognize the full amount of the realized gain or loss. Okay, so with that, what we're going to do is we are going to calculate our amount realized in our adjusted bases. We're going to calculate that for each of these. So I'm going to abbreviate AR minus AB, okay? And we break up, again, this transaction. We're breaking this up. So let's do the apartment for the land. Actually, let's start with the apartment portion for the securities. That one's a little bit easier, and I'll explain why. Okay, so we also have to remember that in tax, and if you're taking my class or if you're taking any other professor's classes or CPA exam, bar exam, law school exam, whatever it is, if you're given a problem, we always assume the parties are arm's length, unrelated, unless we're told otherwise. Like we're told, hey, they're father and son, or they're employer-employee, or it's a corporation and a shareholder. But we always assume, hey, arm's length. Arm's length meaning the parties are unrelated. Meaning that Coconut is going to be giving up a fair market value of items that equal what Coconut gets. So the fair market value of what Coconut gives up is going to equal the fair market value of what Coconut gets. So we know the fair market value of the apartment complex total is $150,000. We know that is $150,000. That means that the fair market value total of what Coconut gives up has to also equal $150,000, which means the two assets have to equal $150,000. Now, we don't know the fair market value of the land. If you want to stop the video and look, you can see you're not given the fair market value of the land. But we are given the fair market value of the securities. We're told the fair market value of securities are $25,000. So that means that the portion of the apartment complex that we get from the securities is equal to the fair market value, which is $25,000. So let's go ahead and we're going to put that there. Again, you're only getting a portion of, again, hypothetically, this is how the tax law does this. It breaks up the transaction. So the apartment complex portion given up for securities is equal to the fair market value of the securities, which equals the $25,000. Now, again, what's given up has to equal $150,000. So that means if we do some basic algebra, right, $150,000 is the total, should be the total amount realized. It's what we get, right? It's what we get, the apartment complex, and it's also what we give up. They both equal. So if we take $150,000 minus the $25,000 fair market value, we get X, which is, again, algebraically, that's how I've inserted that to show you. You can do some simple algebra. So we then know, because the parties are arm's length, that the fair market value of the land in this problem must be $125,000. So again, because we're using that rule that, okay, arm's length, what you give up and what you get have to equal. Also, this is known as the Philadelphia Park and Amusement case. One of the principles from that case is that the fair market values have to equal with respect to a tax transaction like this if the parties are arm's length. So we know the fair market value of one, so we can subtract away and get the other is the idea, because what you're getting equals $150,000. We don't know what one asset is, but we know the total is 150, so we subtract away 25, we get the 125. Okay, we do have the bases of the two assets. The basis of the two assets, we know the basis of the land is $40,000, so we can subtract away $40,000, and we know the basis of the securities, we know that is $10,000. That's given to us $10,000. So that gives us a realized gain or loss for the land portion. That's going to be $125,000 minus $40,000. That is $85,000. And then for securities, we've got $15,000. Now again, this portion, now we go to our recognized gain or loss. You don't have any boot received here. We just have boot paid, the securities. But remember, we're breaking it up into two transactions. These are still two separate transactions. So we've just calculated the realized gain or loss. That's step one. Now we do the recognized gain or loss. Okay, the recognized gain or loss, well, the land portion qualifies for section 1031, like-kind exchange, right? That full portion, because it's a simple 1031 solely for like-kind property. So the recognized gain or loss here is going to be 0. For the security portion, there's no non-recognition rule that applies. Therefore, the general rule, remember, is all realized gains and losses are recognized unless there's a non-recognition rule or some other special rule. So that means all $15,000 of the recognized gain or loss must be recorded. So we've just calculated the realized gain or loss, the recognized gain or loss. You could add those together, and of course, you get a total of $15,000. Now, the last thing we need to do is calculate the adjusted basis of the new building, or the apartment complex, I should say, in the hands of Coconut. So the adjusted basis of the new, which is the apartment complex, received. So remember our formula? We do the adjusted basis of the old plus any money paid, actual or constructive, minus any money received, plus gain recognized, minus loss recognized. And that gives us the basis of the apartment complex. So let's go through and let's calculate this. So the adjusted basis of the old actually includes both bases, the basis of the land and the basis of securities. So we've got $50,000 here, right? Again, that's the $40,000 plus the $10,000, right? If we add those two together, we bring that number down, $50,000. Is there any actual or constructive money paid? No, there's none. What about money received? No, there's none. All you receive is the apartment complex, like kind. Was there any gain recognized or loss recognized? Yes. So remember, we add these two together. 0 plus 15 equals 15,000 gain recognized. So we've got plus 15,000. There's no loss recognized in 6. So therefore, the ending basis in the new apartment is $65,000. Now you can check your work, right? If you do the suspended gain or loss, the suspended gain would all be here. It would all be the $85,000 that goes unrecognized, right? That'd be suspended gain. If you went the next day and sold it for $150,000 minus the $65,000 basis we just get, guess what? You get $85,000. So you've calculated and checked your work with a suspended gain. It equals $85,000. Again, the difference between number 1 and number 2 in total, right? Because, well, securities, the full amount of recognized gain or loss is going to be recorded. So it's really just the non-recognized portion for the like kind. So that's problem 6. So if you want to stop the video, take notes, whatever, because I'm going to go through this now, and I'm going to erase to do problem 7. Okay? So let's go through now, and we're going to look at problem 7. And problem 7, we just change around 2 numbers, and that's why I'm just going to go and change the actual numbers. So in problem 7, it says exactly the same as problem 6. The only thing is that we're going to change the bases. The land has a basis of $18,000 rather than $40,000, and the marketable securities have a basis of $32,000 rather than $10,000. Okay, so now what I'm going to do is I'm going to erase the parts of the problem that relate to those numbers. So of course, in our amount realized, that stays the same. That stays the same, and the reason why is because It's still $150,000 fair market value, and the fair market value securities is still $25,000, so that stays exactly the same. So we do change the adjusted bases of calculating the realized gain or loss. Let's also erase the realized gain or loss, because that's going to change as well. We'll also erase the recognized gains or losses, because those may or may not change. We'll see in a moment. So we got a minus adjusted basis. The first adjusted basis here is we're looking at the land. We're given the land of $18,000. So we subtract away the $18,000. So $125,000 minus $18,000 basis. That's going to equal $107,000. Realized. That's realized. My apologies. Realized gain or loss. Again, this part of the transaction, right, the apartment complex for the land qualifies for non-recognition. So guess what? All $107,000 goes unrecognized. Let's look at the securities now. The securities, $25,000 fair market value, which is the amount realized, that portion, minus the adjusted basis. Well, again, problem 2 it changed, or problem 6, I should say, or 7. Problem 7 it changed, right? Gotta keep track after all these. So our realized loss is now equal to $7,000 realized loss. Well, again, this transaction, there's no non-recognition rule. And the general rule is if you have a realized gain or loss, it must be recognized, unless the non-recognition rule or some other rule applies. There's no special rule that applies. Guess what? We've got a recognized loss of $7,000. So this is, I've told you all the times before, it's possible to have a recognized loss, but it's very rare. This is when you can have a recognized loss. So keep this in mind. When you're going through and and studying for this topic, like-kind exchanges, the time when you can have a recognized loss is when you give up both like-kind and non-like-kind property. For like-kind property, you don't receive any boot, and you're giving up property that has a loss built into it. Okay? So you have this built-in loss, and because you have a built-in loss, you can actually take that loss because that portion of the transaction does not qualify. So we've got our realized and recognized losses. We also have to now change the amount of the suspended gain or loss. That changes to $107,000 because the loss all gets recognized, so that actually gets recorded. So we have $107,000 suspended gain. Okay, now we go and we're going to calculate our new basis. So the old basis stays the same because 18 plus 32, yes, that number did change in problem 7 from 6, but the total is still 50. I did that on purpose. Now we're going to erase the gain recognized and the loss recognized. There's still no money paid or money received, actual or constructive. That's still the case. There's no gain recognized here, right? Because 0 plus a $7,000 loss is going to be a $7,000 recognized loss. So we subtract away the $7,000 recognized loss, and now we have $50,000 minus $7,000. We have a $43,000 basis. So the basis of the apartment complex is going to be $43,000. And again, we can check our work. If we were to sell the apartment complex for the fair market value the next day, right, $150,000, we would subtract away the $43,000 basis we just calculated, because that's the basis we use, and we get $107,000 gain. Boom, equals our suspended gain or loss, whatever is there. Suspended gain here is the case. It equals. All right, so we've completed problem 6, problem 7. Again, keep this in mind. This is when you can have a like-kind exchange, right? And you can also have a recognized loss. Very, very rare, but you can have it. So I hope you've enjoyed this. Please continue to watch the later problems as well.